Welcome to Venture Step Podcast. We discuss entrepreneurship, industry trends, and the occasional book review. In this episode, I'm going to be following up on my previous episode a couple episodes ago called SUS Learnings. SUS Learnings, if you're not familiar, I would suggest that you go back to that original SUS Learnings episode, since it's going to be what I would consider a series. And the SUS Learnings is the startup school. And the startup school is a program offered by Combinator. You can apply, it's free. You just put in some personal information and then you have access to the program. And in a general sense, it's a course on how to make a startup. And the first section that I've completed so far is why should you not start a startup? Who is a startup for and not for? What are the things you should weigh out? Like, what are the pros and cons of this venture? And then the next thing is like, how do you know you have a good idea? Or how do you understand or value an idea? And what are the things you should look for? And in that episode, I talked about a recipe series that they discussed. And there's 7 steps to their idea recipe. And if you can make quite a few of those steps of the recipe, you probably have a pretty good idea. So in this episode, I used the idea recipe to find an idea space for me and some opportunities for me to pursue potentially. So for myself, I've got experience in data, I've got experience in insurance, and that is a good space for me. But insurance can be in all sorts of sectors. I've mainly worked in property, but there's property, there's casualty, and then there's all sorts of other stuff that I haven't had experience with. But in this episode, we're going to be discussing something that is somewhat used in certain areas and sometimes not so much. And that would be parametric insurance. And parametric insurance is a little bit different than traditional insurance. Traditional insurance is you have a claim, so you file a claim. And then if you're in a homeowner's policy, as we're talking about for this example, because you might be familiar with that type of insurance or auto insurance, you file a claim. Somebody comes out, looks at the car, or somebody comes out, looks at the home, and then from there, they would determine the loss amount, and then they've got to go through their claim system, got to write up all your notes, then you've got to file everything, and then the time that all happens, it could be weeks to, if it's very complex, if it's a very complex claim, it might take months. It could take 30 plus days to get paid. Whereas parametric insurance is a little different. You have a pre-agreed upon metric, like say that you have some sporting event that you're hosting, and if it's over 2 inches worth of rain, you will have a loss of revenue because not as many people are going to go. And so you could get parametric coverage on that and say, okay, when there's 2 inches of rain, 2 inches or more of rain in one single day during my sporting event in my specified area, then I'll get money. And so then what you would do with parametric insurance, you still kind of have to file losses, or it's sometimes set up like automated with a API. But then it's still manually underwritten, and then from there, then the payment is processed, and so you're not getting paid for, I would say, 2 to 7 days, which is substantially faster than traditional insurance. But now we have an emergence of technology that allows payments to be processed at a much faster way, able to verify the claims that the insured is making, all within minutes, not days or weeks. And traditional insurance does have its space that it needs to operate in. but there's also space for parametrics insurance to work. And that's something that's pretty interesting to me. Parametric insurance is not necessarily untapped in certain areas. Like California has a pretty good parametric program for earthquake. And there's some pretty cool stuff with blockchain and smart contracts in Africa related to crop yields. And so if your crop yields aren't meeting a certain amount because of the rain, majority of farmers in Africa are, I forgot the exact terminology, but there's a farming term that if you're farming for your family and to feed your family, it's different than farming to sell. Majority of farmers in Africa are farming to feed their family. And so everyone pretty much farms. And then, and I don't ever say everyone, but you know what I mean? Like majority of farmers are farming to feed their family, and they're working their own farms, and it's for their family. And if they don't get a good crop yield, then they are run at risk of malnutrition and not eating enough. I mean, they could buy or purchase crops from somebody else, but if you put in all that money and you're expecting, because you have to put in money and time to have the farm have any yield, and then if the farm doesn't yield, then you've got all this wasted investment, both in time and in money for the seeds and all this other stuff. So once you count all that in there, it's a big investment. And if you don't get anything back, and then you have to pay for your food, it sounds expensive. So they have this parametric smart contract offering, and I'll get into the smart contracts and blockchain a little bit later in the episode. But basically, that's the only application that I could find that utilize this new technology that enables the execution of parametric insurance to be near instant versus waiting a week or so. So I thought that was pretty interesting that people haven't caught on yet. Like we know in insurance, we know that blockchain and smart contracts would be great for insurance in certain applications. But we haven't seen any actual real world attempts at this. And there's some examples like the one I'm talking about in Africa. But other than that, there really isn't anything going on. And I think that's a process or a factor of people working in insurance not being that technical. The exciting, new, shiny things is not insurance. Like that's, that would be like rocketry or social media or AI algorithms. And so those folks that could do the things that these smart contracts and this other stuff, that's not that complicated. I mean, I say that when I don't know how to do it, but on a general sense, like the logistics of it, it doesn't seem that bad. It hasn't been done. And the efficiency gains that you would get from that are immense, both from the customer satisfaction and from being able to process these things without the administrative burden of having someone look at it, verify it, send the money out. Like the money would just send. So that's parametric insurance. I talked about the benefits of parametric insurance, that being it's a predefined metric that if that metric is achieved, then money is paid. And if that metric is not received, like if that metric is not obtained, then money is not paid. And so it makes it very clear to the insured. And I hear this all the time, people getting very confused about what is paid and what's not paid. When do I get payment? When it comes to insurance. And a big thing that happens in Florida, unfortunately, is that people get insurance in Florida and then they realize that their insurance policy doesn't cover flood. And then their house floods and they file an insurance claim. And then their response from the insurance company is, oh, like, sorry, like your policy doesn't cover flood. You didn't get the flood coverage. And that's an issue both on the policy document side and on the agent educating their insured. That's a separate issue. But I use that as an example to just state this is that the insured normally doesn't know really what's in the contract. And it's not necessarily clear on like what's getting paid and what isn't getting paid. And if you work in insurance, you'll be like, oh, I know exactly what it is. If I go to this form number and I read it and then I interpret the language and then I can know what's being paid and not paid. But no one's reading these things. They're like 100 pages and they've got a whole bunch of legal jargon. Like people aren't reading this. So if you had a predefined metric, say, oh, if it rains 2 inches, like I'll just stay with my example I had earlier. If it rains 2 inches, then there you go. You get paid. Either it rains 2 inches and you get paid, or it doesn't and you don't get paid. That's it. It's very simple. And the simplicity and the speed of payment, I think, would be a welcomed addition to the insurance world, especially for things that are particularly challenging. But the challenges with parametric insurance is you could put in some clawback clauses. Like I saw one competitor for shipping delay, maritime shipping delays, is that you have to provide proof of your loss. And then after that, payment will be made. But then there's a clause in there that if you're overpaid, then we have the right to claw back the payment that was sent. And that's by Marsh Insurance. And if you're not familiar, Marsh is massive. So one of the issues with parametric insurance, if you have this pre-agreed upon clause, one, the clause might not hit, which obviously it's not supposed to hit all the time or else I wouldn't be in business. But if the clause is hit, you may or may not have losses. Like if your losses are more than what you had coverage for, then you just won't get paid any more money. So with traditional insurance, you might have $100,000 worth of coverage, and then a claim happens and it might be 25,000. You can still be covered, and then you could be up to a total loss, which is called a total loss. You could lose your whole home, and the full coverage will get paid out. With parametrics insurance, it's a predefined metric, right? So say this 2 inches of rain thing. 2 inches of rain falls at your house. It shouldn't damage your home. And if that happens, money will be paid out, although it didn't cause you any material damage. It might cause you inconvenience, but that's the issue with parametrics insurance, is that you could have a loss occur, but no money will be paid out because it didn't meet the metrics. Or you could have a loss that occurred because it met the metrics, but then your loss that you actually had isn't the same as what was paid out. So there is some issues, and also parametrics insurance would be something that would come over the top for the most part. First, you're not gonna have full coverage with parametrics because it's not a full coverage policy, because the money's only paid out when the metrics have achieved, and so you're not gonna have coverage all the time for anything. So if you had something that wasn't on the contract, like somebody got hurt in your yard, which is like a liability thing, like somebody climbed in, like you had a swing on your backyard, which a child could see. The child climbed over to get into the backyard and got hurt. That would be a liability claim. I forgot the actual terminology for that, but it's something like, that it's a child, doesn't know any better. It sees something that it's supposed to be fun and safe, and then climbs over, gets hurt. It's on you. Okay. So anyways, so you just wouldn't have coverage because we're talking about 2 inches of rain per day and a child got hurt in your yard. Like you don't have coverage for that. So the next thing that I want to talk about is the ideas that I have came up with. And I also used AI to help me research this because it would have taken me too long to do so. And so I read 100 pages, 100 plus pages of research about these topics, regarding crypto, blockchain, smart contracts, parametrics insurance in different areas, pricing, trying to pull data, all sorts of stuff. So we have natural disasters, which I think is pretty well played out. Like parametrics insurance with natural disasters is already a established area. Then you have agriculture, which I talked about earlier, where there's that play in Africa. But my issue with, let me backtrack. I like the idea of natural disaster parametrics insurance, but there's just too many players in the game. But you would get good premium. So you would get good premium. There is no, to my knowledge, smart contracts related to natural disasters. But there is quite a few people in in natural disasters for parametric insurance. Like it's just, I think it's just too established. Maybe I could do more research on it, but yeah, I don't think so. With agriculture, it would be a tough one because one, you are dealing probably with smaller farmers. You'd have to do parametrics outside of the US because parametrics inside the US for farming and agriculture or just agriculture in general, it's already played out. Like there's plenty of coverage. Like people aren't underinsured or anything like that or missing out with parametrics insurance. And so the opportunities are really small time farmers outside the country. And I don't see that there would be that much premium involved simply because we're not talking about multinational corporations or national corporations that are farming. It's really going to be a mom and pop shop. Like how much premium would you get? Business continuity. Business continuity is interesting because it's in many different areas, but one that stuck out was supply chain management and disruption. And that is one of the area of ideas that I came up with. But we'll run through the ideas and I'll tell you what I think about them. So supply chain, and I'm looking at my paper by the way. So supply chain disruption is apparently $18 billion market, and its calculated annual growth rate is 6.6% to 2033. Given the opportunity and the feasibility, I've given it a high because of AIS tracking, the amount of governmental data related to shipping routes and tracking of maritime ships and real-time tracking of shipments. And so you could see all that stuff pretty easily. And I'll go deep dive later on, but we're just doing an overview. Security, breach, and management. They have it at 15.86 billion right now, and we'll have a calculated annual growth rate of 19.52% up to or going to 2033. The issue with cyber is that you need to do penetration testing, you need to do all sorts of things, right? For you to have an opportunity, one, to prevent the attack, two, and you also have to be like integrated into their systems. And the second thing is like integrating the systems and understanding what's going on in the market and studying other attacks and understanding. It just seems like a difficult way to run parametrics. I don't think it's really possible. One thing that you could do is have like parametrics insurance for if like stuff appeared on the dark web, you could execute like your parametrics insurance for the insured. But that was probably the best I could get off of cyber. And I came up with these ideas from just having opportunity, either from lack of competitors or calculate annualized growth rate. So the next one is energy production. Energy production currently is at 17.99 billion. So 17, I just call it 18 billion. And this is clean energy production, and this is energy production insurance. This insurance industry is related to Oh, also, and the calculated annualized growth rate is 4.14%. This is insurance for clean energies. Think about it as like a solar farm or a wind farm that has wind turbines. The wind suddenly changes pace and you don't have production for a couple of days, and it's not meeting your monthly production quota to power X thing or expectations or whatever forecast. And so then you have to go in the energy market and buy energy. This insurance policy would help you obtain the capital to purchase additional energy. And so your lack of production in those days will be protected. This was interesting. There's a couple fundamental issues with it. One, a lot of times these solar farms and wind turbine farms are in a concentrated area, which has issues with risk aggregation. So if I had a lot of exposure with solar farms, and solar farms are out west for the most part, or they're in certain areas, and normally they're closer together than farther apart. If that were to occur and something would happen, then I would lose a lot of money because all my premium and all my exposure is closer together than I would like. And then from there, it's also quite competitive. So there's quite a few issues with energy production. And then another one that I liked was, so I'm mixing up my papers. I did back to back just so I could save paper for everybody in the world. Event cancellation. Of those four ideas, the two best were event cancellation and the supply chain disruption. An event cancellation is a $1.6 billion market and has a 6% calculated annual growth rate up to 2032. Event cancellation is interesting because you could target weddings. Like there's 2 million weddings a year. There is thousands of concerts and festivals a year. So you could start small. You could do weddings. The average cost of a wedding is $30,000. So it's substantial for a lot of people. It's one day you're spending $30,000. You want it to go right, and if it goes wrong, you probably want protection. And you could probably do $1,500 to $1,000 a wedding to provide insurance. And what that coverage is, I don't know at the moment, but definitely if you cancel your wedding, then or you can't cancel, but things need to be canceled, then yeah, money could be paid. Regarding the weather, that could be something, but if it's $1,000, it's gotta be full coverage. Like it's gonna be like, okay, if your wedding's canceled, you get all your money. Like 1,000 to $1,500 is quite a bit compared to the money paid, but it's just like one day. It's like one day. I mean, I don't know. You'd have to figure it out. I mean, it's probably not 1,000, but I mean, definitely not like $200. But there's 2 million weddings a year. Of those weddings, maybe 10% have a need for wedding cancellation, event cancellation insurance. And then let's just call it, I don't know. Let's call it $500. $500 is $103 million if 10% of weddings per year wanted event cancellation insurance. That's a lot of money. And that's not counting concerts. Concerts could also pick up some serious premium, but they're higher risk given that the coverage would be substantial. Like if you did like an ultra or something like that, the coverage would be, or Rolling Loud, the coverage would be quite a bit. And so would the premiums though, but you never know. I mean, a lot of times these places are normally held in areas where that time of year the weather is great, hopefully. So it would just really to prevent severity versus frequency. But I think that there is an opportunity there. To my knowledge, there is event cancellations that are offered, but they're not smart contracts, they're not parametric, and the limits are not too good. And so I think that there is something there that could be attacked if it needs to be attacked. I don't know. And then with the maritime shipping delays, apparently an absurd amount of shipments are delayed, like 60%, something like that, like 53%. No, it's 56.3. It's pretty close to 60% of ships are delayed from the port of origin to the port of entry. And so it's quite a few ships that are delayed. Not until recently, there wasn't any coverage, apparently. I mean, this is pretty new to me, too. There wasn't coverage related to the delayment of a ship arrival related to the loss of production or revenue for a business or a company shipping goods on a shipment container. I did get to look at a couple competitors, and it seems to be that the max coverage offered from 4 people that are offering it are 1,000 to 20. No, I was going to say 2,500, $250,000 in coverage. But the average value for a shipment container, like one of those containers, is 1.1 million. So they're covering about 10% of the actual risk of the container. And they're using parametrics insurance, but they're not using smart contracts and they're not using blockchain to do so. And their payments are a manual process, and they get paid anywhere from 2 days to 7 days later, which is pretty quick given insurance. But there's no reason why that couldn't be close to instant payment. Literally all of the ships are tracked, the containers are tracked, everything is real time. Like, you can go on a map and you could see all the ships that are traveling in the whole world, where they're at, and everything's updated. Like, I was looking at this free dashboard, like shiptracker.org or something. It was tracking 250,000 ships all at once. Every type, fishing ships, cargo, tankers, everything, all on the map. I could see exactly where they were. I could click on the icon and I could see what kind of stuff they were carrying and what they were doing. When's the last time it updated? Everything. So for me, there is no feasible reason why you couldn't have parametric insurance. And the parametric insurance they're offering is if your cargo is delayed. And so, like, cargo delay starts out at like 6 days, 9 days, and 12. And so there's different payouts given the days of delay, which something that would be good. Like you have a severity, like, okay, if you're really delayed, like, here's more coverage, like, here's more payment. But the lack of coverage and my lack of understanding of like why the coverage is so low, it's probably because the frequency is so high. And given that the frequency is so high, they're nervous about offering more coverage, which makes sense. And then I don't understand like the risk ag strategy where like you would need to limit your exposure per port, and then you also need to limit your exposure per ship, and that should spread you out. And no one is going to be able to take over the whole maritime market because it's going to be quite correlated. Like, if a ship gets backed up at one major port, those ships are diverted to another port that delays other ships. And so one delay could just muck up the whole thing. But those are the two ideas: event cancellation and maritime shipment delays. Those to me have the most feasibility, opportunity, and They sound interesting. Like the maritime thing, I love like large industrial projects. Like I watch this thing on YouTube that it's called Mega Projects, I think, and I watch it all the time, especially when I'm like, oh, what's a good mega project that's going on, and then it'll just talk about some random project in Europe or Asia, somewhere in the Middle East, Africa, wherever, sometimes in the US, North America. And the mega projects is like a 1 hour long video just going in detail about what's going on with these projects and how they're being executed. And I just find like large industrial projects interesting. And so I definitely would find ships, like massive cargo ships, very intriguing. Yeah, I would really dig it, honestly. It'd be so cool. Like I get to go on I would go on a ship too. I'd be like, all right, let me check your let me check your shipment here. But with the smart contracts, you would have automation, you would have transparency, you would have security. And those are all things that people are looking for. Like they're looking for something that's stable, that's not inconsistent, that is quick and cost efficient. Like you're saving money both for them and for yourself because they're not frustrated, and then you're not having to hire like a whole administrative team to figure out if their loss is really a loss and if their metrics that they're submitting are really real. It's just all there. Like you have a predefined agreement on the data source and the execution of the contract, and there you go. And then you're good to go. Like everyone's happy. As long as things are clear in life and there's not confusion on whose role is what and who is doing what, then I think people are pretty reasonable for the most part. So my main focus was the supply chain disruption and the event cancellation, both of which I'm going to run with. And I'll have to select a actual idea sooner than later. But these are the two promising ones that I could leverage blockchain and smart contracts to make parametrics insurance work. I don't know which one. I think the easier one would be event cancellation. And there could be there's opportunity in both, right? But event cancellation could be easier. But my fear with it being easier is that somebody else could see that I'm being successful. I'm raising money, and then they could just do the same thing. Like if the barrier to entry is low or not high enough to discourage people, then people just come. But if the entry is a technical feat, then less people will follow because they'll be like, "Oh, that's a cool project," but they're not going to be like, "Oh, I want to do that." There's a difference. Like I want it to be something that, I mean, and maybe events cancellation is hard enough as it is. Like you've got to understand the localized weather patterns in an area, and then understand the frequency of the storms and severity of storms in a localized geographic area. And then you also need to take that into account, and then you have to price for that. And you won't have any data for event cancellations because, well, it's not a known sector. So it would be difficult. But I I think the maritime shipping delays is pretty cool. Helping optimize the world. Sounds sick. But we'll see. I mean, at the end of the day, I just want to get started and start building something. It could be either of those two at the moment, I think are the best. So let's talk about blockchain and like how that would work. So there was two big frameworks or ecosystems, I would say, that I was intrigued about. There's Solana and then Avalanche, both of which are good, and they are building off the foundation of Ethereum. And Ethereum is supposed to be like a faster payment system than Bitcoin, because Bitcoin, it's proof of work, and proof of work takes a long time because it's this computer algorithm puzzle that the miners have to solve. And then once the miners solve it, then they show the proof of work, and then the coin is staked. Whereas Ethereum shows proof of stake, which is different than proof of work. But as well, where Ethereum differs from Avalanche and from Solana is Solana was built from scratch, from the ground up, but it's based off of Ethereum, like the ideas, the approved upon ideas of Ethereum. And Solana was supposed to be, or is the idea was to be a high frequency transactional coin. And the idea was not to have a coin cap, to be inflationary. So the coin is inflationary. And the release of the coins is related to the level of inflation. And when the coins are released, it's normally just to stabilize the price and keep the prices low. Also, a couple things that I think are cool is that it uses proof of history and proof of stake to verify a transaction on the chain. And proof of history is a delayed timestamp of the transaction. And basically, the idea behind it is it's a computational challenge when you are putting together a timestamp. But then once the timestamp is put onto the chain, when you are doing proof of stake, it's easier to verify that it's legitimate transaction, given that you've already showed that you have a history. And then they also have this node piece where it's like node confirmation optimism node confirmation optimism, where if like, and it's not crazy unique either, but if they come to a certain level of optimism of the nodes verifying the transaction, then it just accepts the transaction instead of waiting for all the nodes to finish, which speeds up the throughput of transactions. So the ability to have a massive amount of transactions go through per second is quite unique. And there's been a demo by Firedance, where they had done live like 880,000 transactions a second. Probably not going to get there anytime soon, but it's pretty quick. But they're quoting around 88,000 to 80,000 transactions a second. I don't think they've actually ever gotten to that amount of transactions in 1 second, given that there's not that many people using it. Like Visa has a throughput around 40,000 transactions a second. So you can tell that there's a big difference. They have proof of history and then proof of stake. And there's another cool thing to reduce the cost of using the coin, and that is price. How do I phrase this? So there's this thing called gas fees that's associated in crypto. And so if more people are trying to transact on the chain, it costs the validators or these nodes more money, because you're like, okay, like we're really busy right now. If you want to buy a hamburger, instead of $10, it's 15 or it's 12. And that's okay, because then if people really want to get things through, then they pay for it. But that affects the whole market. That affects people that are doing day-to-day business. That affects people that are just chilling, wanting to do stuff on their computer, whatever. And that affects people that are really trying to push things through. So it affects everybody, except not everyone needs to get affected. And so what they've done is put together a localized high-end volume system. And so the people that are trying to transact a lot and that are putting a lot of strain onto the validators, those folks would pay more than the others. Instead of everyone suffering, the suffering is select, which I think is pretty interesting. And then with Avalanche, I think Avalanche is really cool. Both of them are very cool projects. Avalanche has a lower throughput time. They're saying around 4,400 transactions a second. And Avalanche has some cool things like the subnet, which is supposed to scale horizontally. And the subnet is like a controlled area where you can specify how things will be executed, but also you could scale horizontally. And they're saying infinitely scale horizontal. Okay, I'm not sure if it's possible or not, but that's what they're saying. But Avalanche has a different approach. They still use proof of stake, but they also use this like Avalanche node of consensus protocol where they use independent nodes they use nodes to validate the transaction, and then they randomly seed select nodes within the network, and then from there those independent nodes verify the transactions, and if they come to a consensus, then the transaction is put on the block. And by the way, I didn't explain what a node was. A node is just somebody doing computer work. So it could be a massive data center, the ones that you see that are mining Bitcoin, or it could be somebody's souped up computer, or it could be a server rack or something. The requirements for Avalanche is like 4 gigs of RAM and some kind of maybe like an i5 or something. Like you don't need very much. I mean, you could probably run stuff off of like a Raspberry Pi. So that's a node, and they use node consensus, and then proof of stake. I think that Avalanche has a larger ecosystem per se. Like I think that they have a large amount of tools for you to execute things, but they are a fork of Ethereum, and they weren't built from the ground up. They're like Solana. And the difference between that and Solana is Solana just is on a different level with scalability. And the thought processes are a little different when it comes to the product or the coin. Avalanche is a fork of Ethereum, means it wasn't built from scratch. And so that's also good and bad. It's an improved version of Ethereum, but it still has some of the issues that Ethereum had. The good thing about that is it's an improved version. And two, since it's a fork of Ethereum, then Ethereum tools could be transferred easily to Avalanche. So they might have an easier go at adopting to their program, not their program, their platform. But the main issue is the scalability of Avalanche isn't as much, and then the choices that they're making regarding the type of coin they want is a little different than what I would expect. So with Solana is inflationary. Avalanche is deflationary. So basically it gains value over time, and the coins are limited. And so they announced at the creation of Avalanche that they're going to do 720 million coins, Avalanche coins. And these coins are also burnt during a transaction. So some of the coins are removed from circulation throughout transactions. So it's 720 million, and then 50% of it's owned by investors or founders, and then like 10% is owned by the foundation. So it's like really like 60% of the coins that are in circulation are owned by those groups. So in my mind, one group is trying to be one of the best high throughput transactional protocols in the world to power the ability to transact in a decentralized manner, either with Web 3.0, smart contracts, blockchain, whatever. And the other is trying to pitch like a value proposition. I think they're both good projects, but for the sense of like transacting for like low fees and long-term stability, Solana I think is better simply because they're not trying to make the coin more expensive. They want people to use it all the time. And so if you make transactions expensive or you make the coin expensive, which is required to do stuff on your platform, then yeah, I mean, it just becomes difficult. So that was Solana and Avalanche, and there's one more. It's called Chainlink, which I think is incredible. Like Chainlink is really cool. After doing research about all these cryptos, I'll have to use Chainlink if I want to do parametrics. I think Chainlink would be the way to communicate with the smart contracts for each platform. And Chainlink is the bridge between the blockchain and smart contracts and I guess the real world activities. So whether data, government data, any type of Oracle like data source, Chainlink is the chain that links both the real-time updates of data to these blockchains. And it's pretty cool simply because if you wanted to do parametrics, you could go data from Chainlink linked into your smart contract, either on Ethereum or not Ethereum, Avalanche or Solana. I said Ethereum because Avalanche uses the same language to manage smart contracts as Ethereum because it's a fork of Ethereum, Avalanche is. And then Solana uses Rust, which is a low-level programming language that Solana was built in. So given that, my selection is Solana at the moment. No, I think that's pretty firm. It's pretty firm. No matter what option I pick for like the actual pursuit of the idea and building an MVP, Solana would be the one I would choose. And they actually have an event in like May in New York. So I might have to fly there, check it out. I think that'd be pretty cool. Well, that's it. So I wanted to provide an overview of my progress of vetting an idea. I have to vet an idea, get an idea, find an idea space, which I've done, find a couple of good ideas, which I've done, research them, that's done. The next thing is to find out all the competitors or the legality of each idea. Like, okay, like it might be a good idea, but is there kind of regulations preventing me from doing this? And then keep pursuing a co-founder. And while I'm doing all that, start building. So I haven't researched this as much, but I think I'll build in Go simply because if I have a co-founder and myself and we don't have the materials or the resources to hire somebody, Go would allow us possibly to outsource some of our development work. And the reason why I would be more willing to outsource Go than another language is that Go is very strict. Like in one programming language, you might have 12 ways to do something. In Go, there might be 2. And Go is very simple. It's very strict on the things it can do. It doesn't allow much expression. And Go is built for like massive companies like Google, who was the creator, to prevent engineers from going off the rails and building something that they think is good. And it might be good, but it might be good, but no one understands it, or it might be good, but not optimized, or whatever the issue is. And Go just cuts out all the fluff. And it was like, okay, this is the code. Here it is. There's no decoration. There's no nothing. It's just function. Just everything's stripped out. It's just a roof and walls on there. Like there's no decoration. It's just brutalism at its finest. And that's how I would describe it, is that Go is brutalism of programming language. So that's why I would select go, but still working all that out. Not there yet. And figuring out how I'm going to store everything, building out an application, so much work. But and I'll get it closer. But once I get a fully fleshed out idea, then I'll probably shoot my shot and apply to some incubators. And if they accept me, then then that's GG's. I am going to be on my way then. So we'll see how it goes. But I'd love to find a co-founder. That's on my list. But wherever you are in this world, good afternoon, good morning, good evening. I hope that you enjoyed listening to today's episode and found it intriguing and appreciate my updates. I thank you for holding me accountable for the things I say on here. Even though I don't know you, me saying what I want to do helps me execute simply because I said I wanted to do it to all these people, and they know at the end of the day if I did it or didn't do it. And so it just helps me hold myself accountable, and I appreciate that. But anyways, I hope that you had a great day today or tomorrow, whenever you listen to this. And I hope you listen in next week. See you. Thanks.